Let's talk about accounting assumptions. The first one is the continuity assumption. It's also sometimes called the going concern assumption. Whenever we prepare accounting information, we assume that the business will continue to operate instead of being closed or sold. Basically, whenever we're preparing financial statements, we are under the assumption that the business will continue to exist as long as it has assets. This also implies that the business will continue independent of the owners. Let's take a look at an example. We all know about JCPenney, the big retailer. It was founded in 1902 by James Cash Penney. JCPenney is a publicly traded company and it prepares accounting reports, which we're going to call financial statements. You'll learn all about financial statements later on. Whenever we prepare financial statements for JCPenney, we assume that the company will exist into the future and that it will not be closed or sold. The next assumption is the monetary unit assumption. The monetary unit assumption says that we can express all transactions and events for a company in monetary units. In the United States, the monetary unit is the US dollar. In United Kingdom, it would be the sterling pound. So the monetary unit used in accounting reports depends on the country where the company operates. Another important assumption under the monetary unit assumption is that the US dollar value is assumed to be constant over time. In other words, we assume that there is no change in purchasing power or inflation. So the dollar today is worth a dollar tomorrow is the same as the dollar 10 years from now and the same as the dollar 50 years ago. If you're an accounting major, you will learn more about this in your more advanced accounting courses. The time period assumption presumes that the life of the company can be divided into time periods. Typically, we divide the time into annual, quarterly, or monthly periods. When we report the results of a business, we're going to prepare results for either 1 year, 1 quarter, or 1 month. How often these reports are prepared depends typically on the size of a company. A large company will prepare monthly reports as well as quarterly and annual, but a smaller company will only prepare annual reports. If a company is listed in the stock exchange, they are required by law to prepare quarterly as well as annual reports. The final and the most basic assumption in accounting is called the business entity assumption, sometimes also called the entity assumption. This simply states that the business is a separate unit from its owners. So, if there's a business, its accounting records has to be maintained separately from those of its owner. For example, let's say that you decide to start a lawn mowing business and decide to call it JJ Mowing. The minute you decide to start a business, JJ Mowing is its own separate business entity. And JJ Mowing will have its own accounting records that are separate from those of the owner. Even though you are the only owner of that company, JJ Mowing is a separate unit from the owner. And that is the basic assumption of accounting.